Macro Alf. We did it after a week of messing around. How are you, buddy? Are you good?
I'm good, Peter. How are you doing, man?
I'm good. I do wonder if one of these days we'll jump on one of these calls and be like, hey, man, so yeah, like everything's good. Currency's good. The economy's strong. Government's being responsible. What's to talk about?
I doubt that's ever going to happen, but okay, I see you're optimistic, man. I would say today we still have a lot to chat about.
Oh, yeah. Listen, I have it as hope, but I'm very skeptical. I did an interview the other day with Lawrence Lepard and Quoth the Raven, and it was very pessimistic. It feels like we're in the and we don't know the length of this, but the kind of the final phase of Fiat.
Well, it's always hard. I mean, we discussed it the other time on the podcast, and with you, we always have this fun conversation, right? Where we talk about big picture, but then putting a timeline on it. Last time we discussed the thing of de-dollarization, I think. It's always very hard to put a timeline on these things, but at least it's good if people understand how the mechanics work. For example, I think since the yield curve inverted has now been about 23 months and counting. And by the way, the yield curve is still inverted. It has never disinverted for 23 months right now. And so if you look at history, every time the yield curve has been inverted for more than 8 to 10 months, a recession has always occurred, like 100% track record. And so you wonder, what the hell? Like, is this time different? Which my experience are very expensive words to use in finance. Is this time different? And this is another example when timelines can get very stretched, and we can talk about why that hasn't really generated yet a more severe economic slowdown in the US. I think there are reasons why you can try to justify, but just as a way to say, look, sometimes these timelines can be very stretched and it's hard to attach time to these events.
Just for people listening who don't always understand this, explain why a yield curve inverting, well, what it means and why that's a problem.
Sure. So yield curve inversion effectively means that the yield on a long-dated US government bond, let's say a 10-year bond, is lower than the yield of a 2-year bond, okay, or a 3-month bond, whatever short-dated tenor you're using. So then if you plot the curve of all the yields across tenors, you find that it's inverted, right? It has an inverted shape. Okay, that's what it is. But why would it generate or lead us to a recession in the first place? It's pretty simple. So the front end of the yield curve, let's say the 3-month or the 2-year, whatever you're using, is led and highly influenced by the Federal Reserve. That means that if the Federal Reserve is raising Fed funds to 5%, you can expect, as today, that front-end interest rates will be around 5%, okay? So no rocket science, they can be a bit lower. If the market is expecting the Fed to cut, they can be a bit higher, but roughly they're highly, highly influenced by what the Federal Reserve does. Cool. Now, what about the long end of the yield curve, though? That's a different story, because when the Federal Reserve increases interest rates, what happens is that households and corporates start to find it harder to borrow. I mean, look at where mortgage rates are today, but even a small cap corporate in the US has to pay interest rates north of 8% today to borrow. So what will happen is that automatically they will stop doing that. They will just rein in spending. They will be way less aggressive. And what this does is it slows down the economy. If corporates are levering up less, they're hiring less, they're spending less, the economy slows down. And the long end of the yield curve, so a 10-year bond yield, a 30-year bond yield, is the reflection of the expectations the market has on future growth and future inflation. So if the Federal Reserve is being too tight, it's choking the private sector from cheap money, basically. What the bond market does is at the long end, it says, well, you know what? You're going to make some damage to the economy, right? And you're going to slow down growth and inflation, and we were going to reflect that with lower yields at the long end. So the curve inverts, and the longer it stays inverted, Peter, the more the bond market is telling you, dude, the policy rate at the Fed, it's tight, it's tight, it's tight. And the longer it is tight, the more likely it is that ultimately it causes some economic damage. And this process that we described, tight interest rates, the passage of time, so making sure that these tight interest rates are passed through the economy on a prolonged period of time. It's not a blip. You really have to go through a period of these tight interest rates. And ultimately, the curve remains inverted, leads us with a lag that can be anywhere between 10 months to 27 months. In 2007, it took that long before the inversion and the actual recession, but eventually leads us to strong periods of economic weakness.
And I know recessions are painful, they're very difficult, they're difficult for businesses, they're difficult for households. But don't we kind of need one? Isn't a recession a natural part of a growing economy that we have to have? It's almost like the balancing of the growth phase.
Yeah, on my Substack, I actually put out a chart which is quite interesting. And look, it was provocatory quoted as, "We are not allowed to have a recession anymore." So there is this very nice chart, which I think I can put it up for a second maybe, but this chart shows the months that the US economy spends in a recession per decade. So it goes back like 100 years, and it says, for example, in the 1920s or in the 1940s, the US spent an X amount of months in a recession. And then you go to today and you can see, like, in the last 2 decades, basically, the amount of months that we spent in a recession was the lowest ever. And if you think like a policymaker, Peter, this seems like a great achievement, right? I mean, basically, you are not getting your economy into a recession whatsoever. But then there is a negative side of this, right? Because recessions in a capitalistic economy are a part of the business cycle. I mean, you push the economy too hard sometimes, and to clean actually the economy from agents that are unproductive, you will need a recession from time to time. And of course, nobody likes them, nobody wants them. They want them to be short and they want them to be shallow, but it's a bit of a cleansing, basically, of the economic system. And the last true recession we had in the US, but actually I could say around the world, is in 2008. That's the great financial crisis. COVID was an exogenous shock that effectively forced something on us, but the actual organic recession, the last one we had, was in 2008. Buddy, that's like over 15 years ago. Okay, so we used to have a recession every 7 years on average, or an economic crisis somewhere. So the system was allowed to rebalance itself basically every 7 to 8 years. And now that's not the case. Now it seems like that policymakers are busy trying to do whatever they can to avoid us getting into the next recession. I'm not sure how healthy it is, but it sure buys you votes, I would say, because you don't put the economy through a recession. No one wants a recession during their mandate, obviously, that's clear, but I'm not sure how good it is for the stability of the system. Minsky used to say that artificial stability breeds instability into the system. The more you keep the system artificially stable, the more likely it is that when it pops, when you try to push a balloon underwater, you can keep it underwater, but then the pressure starts building. And I think Minsky meant pretty much that the moment it has to pop above the water, the pop would be pretty big.
Yeah, and we're in an election year, so they certainly don't want a recession now. Is this one of the things that can lead to hyperinflation, in that if they keep trying to delay a recession, they're going to keep having to do kind of clever financial engineering to get out of it, that we will see inflation eventually way beyond the kind of quoted 10, probably 20% we had over the previous years?
So for me, Peter, the main theme of the next 10 years is going to be the volatility of inflation. So I think we're going to have periods of high inflation and periods of very low inflation, possibly deflation as well. Basically, the volatility around the inflation cycle is going to be much, much larger. I mean, over the last 10 years, there was no volatility. The CPI was basically around 1.5% and 2.2% for like 10 years. And I think these levels are going to be way, way more volatile over the next 10 years. So I think the key component to observe here is the behavior of policymakers. There was once a time when, if the economy was running relatively hot and unemployment rate was 4 or 5%, policymakers would say, well, you guys don't need really us to throw resources at you, so you don't need a deficit. We're not going to make a surplus, but we're going to be pretty much balanced, from a deficit perspective, because you're running hot by yourself. You don't need help. So this was an anti-cyclical fiscal deficit. Basically, if the cycle was strong, deficit was small. If the cycle weakened, say in 2009 or in 2001, then policymakers said, well, okay, yeah, we need to do something here. We're going to stabilize the economy. This is a very smart counter-cyclical use of fiscal deficits. But man, I mean, since 2017, because people only look at now, but you have to start from 2017, right? I mean, you had in Europe a lot of political situations. You had in Italy the Five-Star Movement. You had, let's say, non-orthodox policymakers coming to power because people were protesting about wealth inequality and they were going to vote something different. And this started already years ago. You have to go back and look at 2016. You have to look at French elections when Macron barely made it. You have to look at Italian elections. You have to look at all these situations. And as well, you have to look at Trump in the United States, which might as well be a very understandable expression of a protest towards wealth inequality and, the financial system that we have created. And so what Trump did when he came in is he went in with tax cuts, if you remember, pretty sizable. And he came up with a fiscal deficit in 2017 and 2018 when the economy was running pretty hot. And so he started this basically new trend where fiscal deficits are not a counter-cyclical tool. They are a feature of the system. You are just going to be making fiscal deficits because, well, the economy runs hotter that way. And if you're a politician, who doesn't like a hotter economy under your mandate? And I think this really increases the volatility in macro cycles, and we can describe how.
Would you consider Brexit as part of that protest movement?
Yeah, absolutely, yes. But there were many. You can even go and look at Sweden, at Austria, even at rich places, because I always hear, yeah, Alf, but of course in Italy, you guys are not doing that great. Agreed, we are not doing that great. If you look at wages adjusted for inflation in Italy, they have not grown for over 25 years. This is very sad. Actually, they've gone down. So people are losing purchasing power. Okay, that's very, very sad. And yes, there was a protest there in Italy, but there was a protest as well in Austria. There was a protest as well in Scandi. There was a protest in rich places, because it's all about where we're going and how wealth is distributed. And people just protest about it. And Brexit as well was probably part of it, I would say, Peter, of that broader protest vote from citizens. And now you're going into today, where what Trump started officially has become pretty much the norm, and the magnitude of it, by the way, has also increased. Now you're looking at Biden doing double what Trump was doing on an economy which is arguably running hotter than the economy that Trump had in 2017, 2018. And so it makes me wonder. So what happens if an economy is already running hot, and reported data today talk about a real GDP growth in the US at about 2.5% and a core inflation at about 3%. So we're talking about 5.5% nominal growth. That's pretty robust. And then you're looking at deficits being thrown at the economy while it still grows at 5.5%. And let's extrapolate this. Let's assume this is going to happen again, because, Peter, if Biden or Trump are elected again, is this going to change? I doubt it, to be frank. But okay, so let's say they continue doing this. Next time the economic cycle is actually uprising, so you really have this economic momentum and you keep throwing deficit on it, what's going to happen? Probably you're going to overheat the economy. Probably you're going to have bouts of inflation. That's exactly what we saw in 2022, right? And I think we're going to see more episodes where this happens. And then what's the outcome of this? Well, if you see bouts of inflation, then you have two ways out of it. The first is the central banks have to tighten the grip, and they have to tighten it really hard, because now they see these policymakers doing irresponsible things. So they feel emboldened to do something about it. So they're going to raise interest rates. That's option A. They're going to raise interest rates a lot. And, well, that's more prone to accidents to happen, right? Or B, they're going to say, well, you guys are completely nuts. I can't follow what you're doing. So I'm just going to apply a policy that is, like a bit more conservative. I'm just going to keep rates here. I'm not going to hike further. So what happens? The market's going to say, like, what? Inflation is 8% and the Fed isn't hiking, for example. So what's going to happen there is that financial markets are going to find a release valve. And that release valve can be non-traditional assets. So you can have stuff like gold or Bitcoin do particularly well in that environment. And what happens there is that you have second round effects. So this release valve in markets can end up causing more volatility and more situations where the monetary system maybe gets even challenged. What I'm saying is fiscal deficits applied pro-cyclically, not counter-cyclically, so fiscal deficits being a feature of the system, do this new phenomenon increases the volatility in macroeconomic cycles.
Is it not the job of the central bank to stop these cycles being so volatile? And have they essentially lost their independence? Is this why we are in this situation?
Yeah, try to think like a central bank. So if you now have, now let's talk about now, for example. So you have in 2023, you have an economy which is running pretty hot by any standard. And then you have Biden throwing a couple of $1 trillion of deficit on top of it. So if you're the Federal Reserve, Peter, you cannot stop that. You don't have any power to stop Biden from doing deficits. You can't. I mean, it's a political decision, not a central bank decision to do deficits. And so what can you do there? Well, the only thing you can do is raise interest rates, right? And then that's a bit what the Federal Reserve has done. And has it succeeded in slowing down the economy? In this case, not yet and not really. So let's talk about it for a second. How the hell is it possible that interest rates are over 5% and the US economy hasn't yet slowed down that much? Well, the answer, I think, lies in three different angles. The first one is, what is the mechanism by which raising interest rates slows an economy? Well, normally, you will have households stopping mortgages altogether. You will have corporates saying, well, I can't refinance my debt. That interest rate is too high. So what am I going to do? Well, the household isn't going to buy a house, which means you're going to have less construction jobs, which means hiring activity is going to slow. And the corporate is going to say, I can't refinance my debt. So you know what? I'm going to have to stop discretionary spending. Then maybe I'll have to fire someone, but for sure I won't be hiring anymore, right? Because his refinancing is too high. So this mechanism puts us through a slowdown in hiring, a slowdown in spending, and ultimately the economy slows down. But now, wait a second. I just said that this only happens if households have to actually refinance. So if they have to go through mortgage process, or if a corporate has to actually refinance their debt. What if they don't have to do that for a while? Which is pretty much what the US economy is going through right now. It's a fun situation where between 2017 and 2021, the private sector has been very smart. So mortgage rates at 3% for 30 years, give it to me. And they locked it in. And so unless you lose your job, you don't have to sell your house. You don't have to refinance anything. And so you go to this frozen situation. The same goes for corporates. Microsoft, Apple, all these big corporates, they issued 20-year bonds, 30-year bonds, and they were very smart. They locked in very low interest rates for a long period of time. They're sitting on a mountain of cash actually on their balance sheet. So they're making money because this cash is rewarded now, higher interest rates. That's fun. So the asset side of your balance sheet makes more money, literally. And the liability side, well, it's going to take a lot of time until this refinancing cycle really kicks in. And so this is really a very strange period where now there's a new theory in town that higher interest rates are stimulative. I think that's a bit of a stretch, but I want to say that higher interest rates will only bring serious damage when the refinancing cycle gets more real, okay? When more households and more corporates will have to go through the refinancing cycle. Is this going to never happen? No, of course it's going to happen. It just takes longer. And I think that's the part of the macro cycle where we are in today.
Fun. Fuck. All right. Well, listen, look, can you talk to me about what happened in Japan? Because this was where the starting point was to talk to you again, really, is Danny and I had noticed up on Twitter there was a period where a lot of people were posting up the Japanese yen chart, and it was kind of trading like what we call a shitcoin chart in our world of Bitcoin. What happened?
Well, let's start in 1985, would you? Let's take a long journey across.
I was 7 years old.
So in the 80s, Japan was the home of one of the biggest financial bubbles ever, which is the Japanese housing market or real estate market in general of the 80s. At some point in the late 80s, it was estimated that the Imperial Palace of Tokyo was worth more than the entire real estate of the state of California.
Okay.
This is freaking ridiculous, but that's where we were back there, okay? So this was a bubble pretty much fueled by cheap credit. So interest rates were low, the Japanese economy was doing well, everybody was well paid, so they could lever up and go and chase housing, okay? So lending standards were very, very low. So, all the stuff that we know already can fuel a real estate bubble. So at some point, the Bank of Japan said, enough, I think this is overeating, so we have to start raising interest rates. Now, you can guess what happens when you raise interest rates during a credit-fueled real estate bubble. Well, it bursts, right? Because people who have bought 3, 4, 5 houses betting on the fact they could refinance at lower and lower interest rates, now all of a sudden they can't. And so the entire thing, deleverages in front of you and you have to sell your house and it's a balance sheet recession. And it's the situation where you're highly levered, your collateral value, your house price goes down, down, and down. So the only way to repair your balance sheet is to sell your house. And then there are only sellers, and who the hell are the buyers?
Is that like with the 2008 financial crisis in the US? Same situation?
Pretty much the same.
Yeah.
And so what happened then, though, was very, very interesting, because Japan didn't react like the US did in 2009. What the US did in 2009 was, well, rescue a couple of big banks and then come in with fiscal. It wasn't very large, but it was some sort of stabilizer fiscal reaction from the United States. Plus, they managed to stabilize the banking system. It took a while until the US actually restarted its economy. It took like 3 to 4 years minimum, because the reaction was really appropriate in sizing, but it was the right reaction. It was fiscal and backstopping the banking system. What did Japan do? Well, they said, you know what? If the housing market is collapsing, I know what to do. I'm going to cut interest rates to zero. And so they did. Japanese government bond yields went from 8% to zero, basically 0% in a few years. And so authorities thought, well, if I slash interest rates to zero, surely people are going to go and get mortgages, right? And kickstart the housing market again. That's not how it works, because if you just get clobbered in an asset class, which is the housing market, and your balance sheet is damaged and you lost a lot of money, you sure aren't going to volunteer straight away to get more debt on and do again the same game. So what people need at that point is a reparation of their balance sheets. They need a repair. And that repair can happen if the government is doing fiscal stimulus, if the government is throwing resources at the economy, if the government is cutting taxes, it's stimulating economic activity. Cutting interest rates to zero isn't going to convince somebody who just got burned by leverage to get on more leverage immediately. And that's exactly what happened. So what happened is rates went to zero and the Japanese economy flatlined for basically 10 years. So all of a sudden we are in the 2000s and Japan says, well, if zero interest rates haven't worked, Peter, you know what I'm going to do now? QE. It's a new thing. Yeah? They were basically the first ones to adopt QE. Yeah, so they went in and they said, we are the pioneers. We're going to do QE. Yeah, that's what we're going to do. So we're going to take all these bonds out of the banking system. We're going to absorb them and we're going to give banks reserves. That's what QE does. Great. So Japanese banks saw reserves increasing to the roof. The balance sheet of the Bank of Japan went to the moon. They became large buyers of their domestic government bond market, a problem we will discuss in a second. And then they saw, again, nothing happening. So banks were not lending to the real economy. Banks were just switching their balance sheet. They were selling the bonds to the Bank of Japan and they were getting these reserves. And the Bank of Japan was wondering, like, what the hell? Like, why is lending not increasing? Well, banks lend to the real economy, not if they have more reserves or less reserves. They lend to the real economy if they see a good potential return, if they see credit-worthy borrowers, if they see strong economic activity. They don't give a crap if they have $1 trillion of reserves or $2 billion of reserves. That's not what drives banks to lend. Again, another inappropriate monetary policy response. And so we are now about 2010, 12, 13, and interest rates have been at zero for 2 decades in Japan, and QE is going on. And I'm going to pause here for a second.
Well, so Lynn Alden talks to me about, she talks about the debt to GDP ratio, event horizon being 135%. She said, once you've hit that point, you cannot return from it. Now, she said, of the last 52 economies that have done that, the only one that survived it is Japan, but they survived it through stagflation.
So what Japan has basically done is a very interesting setup here, because Japan is a net exporter of capital to the world. This is quite interesting. So what Japan did in the 80s and in the 90s, it not only had a real estate bubble, but it was also the tech center of the world. So manufacturing, anything robotization, anything that was tech was Japan. So Japan became a big recipient of world flows. Everybody wanted to trade with Japan. And there was even a political dispute between the US and Japan because, Japanese, the yen was having a certain behavior from a foreign exchange perspective that the US authorities didn't like. So basically Japan accumulated all this capital, right? And it accumulated capital. And it became a big exporter, because once you accumulate, this capital, you have to invest it somewhere, right? And so what Japan did, starting basically from the 90s, is they started investing in foreign bonds. So they became big buyers of US treasuries. Today, Japan owns over $1 trillion of treasuries alone. And then they own now another 500 billion of euro-denominated bonds. So German bonds, Italian bonds, French bonds. They're big buyers, okay, of foreign bonds, because they need to recycle this money that comes in through trading with counterparts, okay? So why am I saying this? Is because Japan has therefore a positive net international investment position. That means it has more foreign assets than foreign liabilities. That's important because it's a creditor to the world, it's not a debtor to the world. And the second thing is the debt that Japan issues is almost solely denominated in Japanese yen. So again, is making sure that Japan doesn't have a debt problem denominated in other currencies, so the debt is denominated in Japanese yen, and the assets that Japan has instead are for a couple of trillion foreign denominated assets. So you can see on a balance sheet level towards the world, Japan doesn't owe foreign currency, Japan owns foreign currency on a net basis. And that's quite important because it allows a country, even with large debt, to be more stable. Because versus the world, it is a creditor, while in a closed system in Japan, all denominated in Japanese yen, you might say Japan is very leveraged. Sure, but it's your own currency. Towards the world instead, you are a net creditor. And that's very important.
Is that quite a unique position they're in then?
Yes, there are not so many countries that have that. I mean, there are a few others out there that have accumulated large foreign positive positions, or net international investment positions that are positive. Japan is not the only one, but I would say this is something that is always in contrast with the United States. So when this is the typical argument that people want to make to say, yeah, okay, you're right, and then look at the US. US is in the completely opposite position, because if it's true that the United States has most of its debt issued in dollars, so that's a positive, right? You issue your debt in your local currency. Well, if you look at the net international investment position of the US, it looks horrible. It looks horrible because the US has a current account deficit, and because the US has bonds that are bought by foreign entities. So foreign entities like Japan or China are owning US treasuries denominated in dollars. So they own your debt, which is a negative net international investment position. And so they say it's got to blow up. It's got to blow up because it has the opposite situation of Japan. It has high debt, which is bad. Sure, denominated in domestic currency, that helps, but it also has a negative international investment position. And there the point is quite interesting, because the negative international investment position of the US is a construct of our system. We chose the dollar as the global reserve currency of the world, and then we chose to lever up the entire world for $12 trillion. This is the Eurodollar system. We chose to lever up the entire world in dollars. So basically, we have chosen the dollar to be the denominator of most of the activities that go on around the world: commodities trading, services trading, goods trading, anything like that. It's basically denominated in dollars. And so the US effectively must supply the world with treasuries. And let me try and explain what the hell do I mean there. So if a Chinese corporate or a Brazilian corporate sells some commodities or goods or whatever, they often get paid in dollars today. That's what happens. That's how the system works. So what they do is they sell stuff and they get dollars back. Nice. So then a corporate has dollars, and these dollars enter the banking system of the country. Let's say Brazil. So a Brazilian corporate has sold soybeans and they receive dollars, and they take these dollars and deposit it at a Brazilian bank. So now all of a sudden a Brazilian bank has dollars. So what will the Brazilian bank do? Well, they need to invest these dollars somewhere, Peter, should they? And so think of it as an aggregate now. Brazil receives a ton of dollars by selling commodities to the world, okay? And so these dollars must be invested somewhere. They're a surplus for Brazil. They must be invested somewhere. So where? Well, you want a liquid instrument, something you can sell, right? Something that is liquid, something that is relatively not so volatile. So you go and buy T-bills. You go and buy short-dated US government bonds because it's a gigantic market. And what you want is that the US actually keeps issuing more of these T-bills, because then you have more space where you can actually recycle back your hard-earned dollars. So this is the system we have created. If the US tomorrow were to decide not to supply the world with treasuries, to supply the world with this collateral that needs to be there to absorb these dollar flows, you would actually have a problem. You would have a system that shrinks on itself because of the absence of collateral.
So people couldn't trade with each other because there'll be a shortage of dollars.
Yeah, pretty much. So the other thing is the current account deficit. I mean, the US is basically in charge as well of making sure that there is a consumption element basically coming from the US. So US consumers are big consumers of foreign products. So effectively what they do when they consume foreign products is they ship dollars away, right? Which is what the system needs to be fluid. So both the US and Japan are very special basket cases. The first one is Japan because the debt is fully denominated in Japanese yen and because they own foreign assets. And the US because despite they are in the opposite position where they owe to the world, so current account deficits, fiscal deficits, etc., they owe to the world because this is how we decided to construct the Eurodollar system in a way that the flow of dollars, the flow of treasuries and dollar collateral must be ensured from the US to make sure the system can keep working.
So how unstable has this made the world, or has it actually brought some certain amount of stability as well?
Well, as long as everybody cooperates, it's a very stable system. Yeah. I mean, the cooperation comes from the fact that Brazil trades in dollars and China trades in dollars, and everybody else has decided that they want to comply with the system. And as they comply with the system, what happens is, well, they get paid in dollars, which means they must want a place where to recycle these dollars, which means the US will be doing this big issuance, and there will always be someone that is looking for safe, short-dated collateral, T-bills, government bonds, where to recycle these hard-earned dollars. Now, as long as this works, what happens, the second step is that at some point the Brazilian corporate might decide to lever in dollar. That's interesting. So they will be issuing bonds in dollars, basically, despite they're not a dollar-based company. They're in Brazil, but they will be issuing dollar bonds because they understand that the business is in dollars. You make money in dollars. And so if your cash flow and everything that comes in the company is in dollars, you can also lever up in dollars and therefore basically try to boost your earnings and your operating earnings all in dollars. But now you're a Brazilian company that has dollar debt. Oh God. So how do you service dollar debt? Well, with dollars, it's pretty simple. You need dollars coming in so you can pay your dollar debt. Well, now you understand the mechanism here. If dollars stop flowing in because trade growth is slowing, the US isn't supplying enough, there is a dollar shortage coming in, well, what happens? If you have dollar debt, how do you service it without dollar cash flows? You can't. So you will be rushing towards the dollar. You will be buying spot dollars in the market because you need to service your liabilities and your debt to stay alive. And the system becomes more and more entrenched about the role of the dollar. As long as everybody remains within the system actually gives stability as long as everybody complies and as long as the flow of dollars is smooth and ensured. And in that case, you might want to argue that it's a positive system for certain economies that all of a sudden have access to global trades in one currency that helps them, participate in the system more broadly and more easily because there is one common denominator, right? So you don't have to trade with Sri Lanka in their currency because you have no idea about how their currency is worth or whether it's going to devalue or not. You will trade with them in dollars. And so Sri Lanka will comply to the system and enter the system and get some trade flows. As long as everybody complies and the flow of dollars is smooth, the system is actually beneficial. But it's another Minsky type of system where artificial stability breeds instability because you need to be careful about providing this flow of dollars smoothly every time, and the Eurodollar system must be working smoothly. Otherwise, you have problems.
Well, there must be a risk if you have domestic inflation, which is higher than the rate of inflation of the US dollar as well, because if you're servicing US dollar debt or you're buying, if you're buying things priced in US dollars, and you've got higher inflation, I guess this is these situations you see with someone like Sri Lanka where they can no longer afford to import fuel because of the high inflation just makes it too expensive.
Yeah, that's correct. So the system, let's say, works as long as you're productive, you're an economy which has good fundamentals, you comply to the system, and the flow of dollars is ensured. Well, that's a lot of ifs, but at least it's a system that has allowed so far few economies to expand on trade growth, right? But it's a system that inherently has weaknesses. And I would say the first one is there are 12 trillion of dollars denominated foreign debt out there. So this is debt issued in dollars by entities that are not in the United States. What the hell? Like, how are you going to service this dollar? You don't have organic access to the dollar. You're not a US company, but yet you decide to indebt yourself in dollars. And so this is inherent fragility because leverage works two ways, right? It works very nice to boost your business model and your balance sheet when everything is going nice, but it also works against you. The problem here is that it works against you in a currency that is not yours. It's in a currency you cannot print. It's in a currency your policymakers can't print. And so the Bank of Brazil can't print dollars. And this is why this swap lines exists. Now, central banks have swap lines with each other, certain central banks. So again, the Federal Reserve is basically handpicking which central banks they want to provide dollar liquidity with. And some of these central banks, in emergency situations, might ask the Fed to actually deliver dollars to them. And these dollars will enter the banking system. And hopefully, from the banking system, they will go to the corporates which are in trouble. But again, it's not an organic access to dollars. The only organic way is through trade growth. But what if the world is slowing down and you are leveraged in a currency which is not yours?
Just back to the yen. Did we actually finish that off? Did we actually cover why it was so volatile?
Yeah, I like when we talk about stuff because at the end of the day, we always end up on another tangent.
Yeah.
So this was the case. So on the yen, what we ended up saying there is that interest rates were at zero for like 2 decades, and Japan wasn't seeing any growth, and QE wasn't generating any bank lending because that's not how it works.
They ran out.
And so at some point you have Abenomics. So somewhere in 2013, I think, Abe became the prime minister of Japan, and he decided he wanted to do things differently and be a bit more stimulative. And he actually did. But to be frank, what happened is that he also doubled up on easing. So he said, look, we're going to do a little bit more fiscal, we're going to be a bit more aggressive there, but most importantly, we're going to do more QE. Let's go. And so they went and they doubled and they tripled their QE. And at some point, Japanese government bonds were not to be traded anymore. The Bank of Japan owned 60%, this is fun, 60% of the market cap of Japanese government bonds. I remember when I was trying to look into them for my previous employer to find some trades there were Japanese banks telling us, not sure, like I don't have any free float to really trade in size because it's all being bought every day by these guys, the Bank of Japan. That was pretty impressive. And so Japan ended up owning 60% of the domestic government bond market.
And that is an issue because it gives less trust in the yen?
No, what happens then? It's pretty simple. The liquidity in the government bond market is non-existent.
Oh, okay.
So you don't have any signaling effect that comes from prices. I mean, government bonds are used as a financial benchmark for pricing loans and pricing mortgages. And, they're used as a reference from banks to price financial products and also products that are used by people, mortgages, loans, etc., etc. Now, there is no signaling effect anymore when the central bank owns 60% of the market. It's like it has lost all its signaling power. And so at that point, the Bank of Japan decided that they had to change something. And so they said, instead of buying a certain amount of bonds, we will do something called yield curve control. They didn't call it like that.
Mm-hmm.
They called it with another name, but it's effectively what they did. They said 10-year government bonds from tomorrow are allowed to trade between X and Y yield. It's a very narrow band. And we decide what that yield is. And if you don't believe us, you can try and get outside that band and we'll put you back. So basically, they would promise to buy an unlimited amount of bonds whenever you try to push interest rates too high. It's akin to a yield curve control, de facto, right? They're basically pinning the level of interest rates. And if the market was going to push interest rates higher, they would come in and buy an unlimited amount. I don't want to be in the face of a central bank that has an unlimited balance sheet because as a private sector guy, you will never be able to compete.
But it does sound to me a little bit like price fixing.
Yeah, basically they said, government bond yields can be roughly around 0% for 10 years. They moved a little bit the yield based on economic conditions through the years, but it was a very, very narrow band. And so this way they could basically scare people of not selling their bonds and not apply selling pressure, because they knew that if they would go short the market, there will be a big buyer with unlimited capacity.
Okay.
But they actually didn't have to buy bonds anymore. Think about it, Pete. They don't have to buy bonds. They just have to scare you not to sell your bonds, and that's it. So that was very smart, because what ended up is that they could continue pinning these interest rates where they wanted them to be without having to enlarge their balance sheet and grow their footprint on the bond market. Yeah, but again, we're talking financial mechanisms here, and Japan didn't see any growth, and Japan didn't see any inflation for like 20 years at this point. Core inflation in Japan between 2000 and 2020 was on average negative 0.2 or 0.3%. So this is a country which was zero core inflation, if not slightly negative over time. Okay, it's a country that can't grow in real terms, but not even in nominal terms. Okay, great. So what happens to the yen at this point? Well, let me ask you something. If somebody would say, Peter, I guarantee that you can borrow a currency, and the central bank is basically telling you that you are certain that you will be paying an interest rate of maximum 0% to borrow. So basically, they're making you borrow the yen for free, pretty much.
Sounds great.
Sounds great. And then you can go and buy whatever you want to with it, right? You can borrow the yen, and then you can buy any other currency. And the fun thing is that most of the other currencies were, of course, yielding a little bit higher than the yen. This is already before the pandemic, right? So the Fed funds were at 2%, for example. So there was a spread to be made.
Yeah,
this is
good arbitrage.
the famous FX carry trade, where you borrow a very low interest rate currency and you put the proceeds into a higher yielding currency. And then you have a differential to be made. And as long as nothing changes, there is no volatility, you will be just pocketing in money. And this is what started to happen already. And what does it do is it basically lowers and devalues your currency slowly but surely, because these interest rate differentials remain elevated and people just get on with this carry trade. And now fast forward to today, you have a situation where this has become even more aggressive, because the euro yields 4% and the dollar yields 5% and the sterling yields 5% and the Canadian dollar yields 5%. You see what I'm saying? All other currencies in the world are yielding 3 to 5%. And the yen is yielding 0. Still 0. And now this is still 0 despite we have had core inflation in Japan crossing 2% on the upside. And you would expect at this point that policymakers say, well, whoa, we have made it. Let's adjust our monetary policy. But they come from decades of zero interest rates. They really want to be sure that there is a new inflationary dynamic in Japan after 2 decades of core inflation being 0%. They're a bit hesitant, to believe that inflation has really picked up in Japan. So they're taking their sweet time. And by taking their sweet time, they're devaluing the yen, because the yen still yields 0. And now you can buy a suit of currencies that yield 4 or 5%. And so this FX carry trade has become more and more and more prominent. And so the yen devalues every day. And now we go to the point where, in the meantime, I'm going to make a small intermezzo, because I'm reading here a news that I think I should share with people.
Yeah, tell me.
GameStop is currently 115% up pre-market. So that's double the price, double the pre-market. AMC plus 97%. It's happening again, ladies and gentlemen. It's 2021 all over again.
How is that happening again?
Well, I think we talked about the two options before. When you have fiscal deficits on an already hot economy, the central bank can decide to do two things. They can either play ball and hike interest rates seriously, like go for it, or they can say, well, guys, I don't know what game you're playing on the fiscal side. I don't feel like to hike interest rates to 6 or 7%. So I'm just going to pause here and hope that this turns for the best. Option B is what the Federal Reserve is doing now, Peter. I mean, we have had a quarter of hot inflation data, a quarter, not a single month. And they went and asked Powell, hey, Powell, what do you think about hiking rates? Have you seen where core inflation is this quarter? Have you seen wage growth reaccelerating? And Powell was like, hike? What did you say? Hike? And I don't know what you're talking about. I only want to cut rates. I'm just waiting for the moment I can cut rates. And so the market understands, oh, well, you are really not that serious after all, right? I mean, inflation is accelerating and you're not really going for it. So let me find a couple of release valves, okay, in markets. And so the market goes and finds release valves. If it's not interest rates, they will go and chase assets. And so you normally see commodities doing well, gold does well, Bitcoin has also been doing well. You also see the more aggressive animal spirit fringes of crypto doing well. Right now you see AMC and GME and GameStop doing well. I think it's an expression of a protest towards monetary policy authorities that are not really reacting to this fiscal dominance situation, right? And that's what we're watching.
It's not the short squeeze again.
Well, of course, there is a dynamic there, because now what's going to happen is that all the Reddit crowd is going to go all over it and try to short squeeze on top of it. But the fact that dog with hat has gone up 900% over a weekend, the fact that you have had super animal spirit speculative assets, this is true everywhere. You have had silver rallying, you have had gold going to the moon, you have had the more animal spirits driven assets. The assets, Peter, where you can't say, look, I'm buying this because I've made a cash flow assessment. It's your cash flow assessment on dog with hat and silver. Give me a break. There's no cash assessment there. It's an expression of a momentum, an animal spirit. It's almost a protest. It's a release valve. And that's what it goes. And now it starts as well here with GME and AMC. And I'm sure at some point there will be a situation where dealers are gamma squeezed because these are names where you always are short because these companies are crap. And as you're short and the entire retail crowd is lifting you, you are forced to cover, and then you will exacerbate the move. And we will see these dynamics again. But I think you need to reflect on why it is happening now, after dog with hat, after gold, after all commodities, and after look at Carvana. I mean, a company that was basically bankrupt at some point was rallying 100% overnight a few weeks ago. Same story. Animal spirits are raging hard again.
Okay. Anyway, so
small intermezzo. So we're at Japan, and so the yen devalues.
Back to Japan.
Yeah, let's try to finish the story in Japan. And so the yen devalues, and at some point, the Bank of Japan has a choice. Do they want to play ball? Do they want to hike interest rates to a level where people cannot do this FX carry trade anymore? So do they want to hike to 3, 4, or 5%, Peter? Basically, the answer is no, they don't. They want to be very gradual, and they want to take it slow because they don't want to ruin this window after 20 years. They don't want to be too tight, right? They want to make sure that this inflation thing actually comes up in Japan. And so what? Like, if you don't hike interest rates, I'm sorry, but people are going to continue to go for it. They're going to devalue the yen. They're going to use it as a borrowing currency for the FX carry trade. So what's your option? Well, again, Japan is in a decent position, luckily for them, to have $1.2 trillion of foreign exchange reserves. So as we discussed, Japan owns foreign assets. They have over $1 trillion of dollars, euros, and other large currencies. So what happens? Well, at some point, the Ministry of Finance says, oh, you're shorting the yen every day. You're liking it. You're enjoying the ride, right? And then they come and they say, well, you know what? I'm going to now dump a bunch of dollars and euros on the market, and I'm going to buy the yen.
To defend it.
Correct. So this is something they had to do already in 2022 once, when the yield differentials were rising aggressively. You remember 10-year yields in the US went to 5%,
Yeah.
and the dollar was appreciating versus the yen, and they came in and were forced to do this. And now they're doing it again. They're doing it again because the only way to structurally fix this would be if the Bank of Japan hiked to 3 or 4%, but they're not going to hike to 3 or 4%. And so you live in this weird environment where the central bank can fix it, but they won't. And so the Ministry of Finance has $1 trillion of reserves to use. Now, $1 trillion is a lot of money, okay? And here we should discuss for a second, what do they do? Because I think I've heard a lot of people say they sell treasuries. They sell treasuries, and this is how this is going to cause a disaster in bond markets, because they will have to offload a bunch of treasuries to.
Yeah.
But that's not exactly how it works in the first instance. So if you go on the Ministry of Finance website of Japan, you can find the decomposition of their $1.2 trillion of foreign exchange reserves. And you will find almost 200 billion of these are cash or cash equivalent. So basically, this will be reverse repo operations or cash deposits that the Bank of Japan can unwind, and they literally have cash at hand to offload. So they don't need to touch their bonds, okay, to be able to really do these operations. 200 billion without touching any bonds, how much is that? That's a lot. So for reference, when they intervened in 2022, I think it was about 25 to 30 billion, one intervention to stop the market. So 200 billion is a bit to go. But I mean, there can be a situation where this goes on for months. Because think about it, if Japan doesn't hike and US rates stay at 5% for another 9 months, for example, let's say it's a very long cycle. Hey, at some point, these cash deposits are going to run over, and then you need to have a look at what are they going to be doing with bonds. And there, it's important to understand that all central banks that have foreign reserves and they invest them in bonds, they don't buy 10-year or 30-year bonds. They're too volatile. Remember what they want to do with these reserves, these foreign exchange reserves. They want to park it in a safe spot that is not so volatile. And so they buy T-bills, they buy 2-year bonds, they buy very short-dated bonds. So even if they sell these bonds, these are low duration. Those are short-dated bonds. They are not going to rock the entire bond market of the US, but they are going to have an impact at that point, but it's far, far down the road. First, they will sell deposits.
It feels like a global managed decline. It's like everybody is competing with each other with this financial engineering, but ultimately, for the vast majority of people, they are becoming, in real terms, poor.
Yeah, I mean, all we are discussing here is trying to keep the system in balance. So have this, let's say, artificial stability situation continuing. But we discussed as well that Minsky said that artificial stability leads to instability. And I think that so far, for the last 10 years at least, the reason why this artificial stability didn't seem very challenged is because fiscal was only used counter-cyclically. So when the economy was weak, you were doing fiscal, and vice versa. You were not doing fiscal when the economy was strong. But now you're adding something that inherently adds volatility to the macro cycles. You're saying we're going to be doing fiscal regardless of whether the economy is strong or whether the economy is weak. And that adds a lot of questions, because when you do it when the economy is strong, you're going to be basically questioning the central bank. What do you want to do? Do you want to fight this for real? Do you want to hike interest rates? Or you're chicken scared and you will not be doing that. And so the market is going to go for the volatility. The market's going to chase the assets. The market's going to chase gold and Bitcoin and other assets that put, with their price action, questions in the mind of people, right? They question the monetary policy stability. They question the monetary framework that we have. In either case, whether you hike interest rates a lot in a very leveraged system, I mean, global debt is over $300 trillion. Private debt to GDP in the US and in other countries is over 150%. This is the private sector debt. I'm not even counting the government right now. When you hike interest rates aggressively, you will be challenging that leverage and that instability that looms behind these very high levels of leverage. Or otherwise, if you don't hike, you're going to be challenged by price action that actually goes and challenges your monetary framework. And I think you're going to be seeing a lot more of these episodes over the next 10 years.
And do you think those episodes over the next 10 years will bring the stability back, rather than just having a large recession? It's kind of it's a way of managing away the debt.
No, I think what's going to happen is that we are going to be having a bit more cleansing episodes where basically the reaction is so vicious and convex that policymakers don't find weapons to immediately contain it, which is their aim. They want status quo stability. And ultimately, I think they will still try hard to try and contain this kind of vicious reactions. But I think you're going to be seeing a lot more sparks. You're going to be seeing a lot more high flames before the firefighters are able to come in, right? And so what I expect is a situation where instead of, you buy some stocks, you buy some bonds and you go to sleep, which was pretty much what happened in the last 10 years. Maybe you buy some houses to top it off. But this is what, between 2012 and 2020, it was as boring as that, literally. And everybody felt very smart, by the way. Everybody felt rich. They became rich because they bought a house. And then the central bank lowered interest rates, and all of a sudden their house was worth more. Okay, that's basically how people felt investing was like. I think over the next 10 years, it's going to be a bit more of active risk management and seeing these high flames coming and having a portfolio that has assets that can do well when the flames are high, because I think there will be periods when the flames are high.
How do normal plebs protect themselves against this?
Well, that's a good question. I mean, I would say that if you go to an advisor and you hear just do a 60-40 portfolio and go to sleep, you should run for the hills, because first of all, the 60-40 portfolio only has two assets. It has stocks and it has bonds. That's it. But what about the rest? What about assets that can protect you from an inflation spike? I mean, if inflation goes up, I'm sorry, but the bond market's going to sell off, and most likely the equity market's going to sell off as well. Look at 2022. So then all of a sudden your portfolio is down 20%. So do you have something in your portfolio that does well if inflation picks up? If the flames are going high, basically, do you have something that does well? Now, okay, what does well when inflation is high? Well, it depends from the type of inflation, but it can be monetary metals, it can be Bitcoin, it can be energy, it can be other commodities. Okay, but do you have some of these in your portfolio? Because if you don't, then I'm sorry, but you're not very well equipped against these flames, right? And so effectively, you need to think about different macro scenarios, and you need to think about assets that are good at protecting against different macro scenarios, because you're going to be seeing a different color palette, I would say, over the next 10 years than the very boring 60-40 gray of very controlled growth and inflation you have seen over the last 10 years.
So it's just, we're going into a kind of like a period of unknown that people are just not used to.
Yeah, I would say so. And again, recency bias is one of the malaise, I would say, of financial markets. It's recency bias, and it's what I call the neighbor tracking error. So what's the neighbor tracking error? It's basically your neighbor has invested in certain assets that have been very popular over the last 5 years. So he's become richer than you, and you're tracking behind your neighbor. So you have a tracking error against your neighbor. And so if you don't have certain very popular stocks or a certain popular portfolio, maybe even if it's highly concentrated and not very smart, if you don't have it, you're tracking behind, And so you need to fix that. And so you have your neighbor tracking error. And I think instead you need to think a bit different. You need to think like, hey, if macro is going to be more volatile, if macro is going to be more uncertain, do I have assets that protect me against high inflation, against deflation, against a strong dollar, against a monetary framework that gets maybe challenged for a certain period of time? Do I have assets that are able to protect me in that case?
Yeah, sadly, I think most people are not aware of what's going on. And look, we're naturally aware because we're Bitcoiners. We make a Bitcoin show. Bitcoin is an asset people buy to protect themselves against this. But there's sadly just a wide group of people who are completely unaware of what's going on, and most likely be the ones who get absolutely fucked when this happens, which is really sad. Look, there were loads of other things we could have covered today, but I think that's a nice place to round it off. That hopefully people will sit back and go, okay, I need to be prepared for these high flames that come in. As ever, we will direct the listeners to your Substack. Drive some people to it. And I appreciate you coming on. I appreciate we finally got this done after a week of back and forth.
It's been a pleasure to do this, Peter. I'm a friend of the show, so every time you want me to discuss some macro stuff, please invite me over, and I'll be happy to do that.
We will do. I love how you explain things. I always feel like I learned something with you, so I appreciate that, Mr. Macro Alf. All right, we will jump that in the show notes. Thank you to everyone listening. Go protect yourselves. Things are going to get crazy. All right, peace out.